Welcome back to the channel where we break down the most misunderstood money myths and give you the real scoop. Today, we're hitting one of the biggest misconceptions about infinite banking.
That's right, Jonah. The myth that we're going to be busting today is this. Wait, so you're just borrowing your own money? That makes no sense.
You know what, Sean? I bet you someone said that exact same thing in the comment section of every infinite banking video ever made on YouTube since 2010.
Facts, man. And it always comes with this look like they just cracked the code or something.
Let's be real, that logic sounds good until you understand how the mechanics actually work. Because if we were just borrowing your own money, we wouldn't be here, and neither would thousands of people building wealth through the infinite banking concept. So let's play this out. People here, you can take a loan from your whole life policy, and they assume
that you're just taking money out of your account like you're pulling cash out of your wallet.
And then they say, why in the world would I borrow my own money and pay interest on it? That makes no sense. And they're right, Sean. That wouldn't make any sense. I wouldn't do that.
But here's the plot twist, Jonah. That's not actually what's happening. Let me explain. When you take a policy loan, you're not taking your money out. Your deposited value stays right where it is.
Exactly. The insurance company lends you their money and then just uses your cash value as collateral. So your money is actually still in the policy, your money. It's compounding like nothing ever happened.
So if you know us, you know we don't beat around the bush. There's nothing to hide when it comes to infinite banking. So yes, you're paying interest, but you're paying interest on their money. And because your money never left the policy, it keeps earning dividends and interest the entire time. That's what we in the biz like to call constant compounding. You want to give them a quick example, Jonah? Maybe some visuals? I know visuals really help me out.
Oh, for sure, Sean. So let's say I've deposited $100,000 into this policy. And then in order to go flip a house, I actually borrow $50,000 from the insurance company provided cash value inside my policy. See, my policy is actually still compounding on the fully deposited $100,000. Meanwhile, I'm of course making profit on the house flip.
So Jonah, I just want to make sure I'm understanding this correctly because I'm not personally familiar with any other vehicle out there that can do this. So you're saying the same $50,000 that I just took out is currently earning for me in the policy like it was the full $100,000, and I'm still making money in the real estate deal with the $50,000 that I took out.
The same value, sure, but I did not do a withdrawal from my policy, Sean. That's big. A lot of people miss that. See, I put in $100,000. I did not ask for a withdrawal. Instead, I asked them to loan me $50,000 of cash value.
I know we're talking about busting myths, Jonah, but what we might need to talk about is witchcraft, because that, my friend, sounds like some black magic. You said I can use my money to earn in two places at once, and I get to use it without losing the growth of it? Well, damn.
That's the power of infinite banking, man. It's a wealth strategy, not an expense. You're building a system. It's not some generic ceramic piggy bank providing 0.04 interest rate and a nice penalty if you actually need to access the money.
And correct me if I'm wrong, Jonah, but if you're disciplined enough to use it wisely, meaning recycling those dollars back in, just like a bank does, there's a good chance that you'll never view your money the same way again.
Exactly, Sean. Let's address this second half of the myth. People say, but you have to pay interest. That's dumb.
Listen, Jonah, I don't know about you, but if I borrow $20,000 from the policy and I make $40,000 from the real estate deal, you better believe I'll gladly pay a few $100 in interest just to keep everything else growing. That's just me though.
I agree with you, man. I'd take that deal too. You don't have to sell off all of your investments to get access to your cash. That's big. I'm talking about you don't even have to trigger taxes and then interrupt your compounding. That flexibility to me is worth its weight in gold.
And don't forget, Jonah, you control the repayment terms. Unlike every other single scenario out there that you've ever been in, this time you're the banker, which means you decide how and when you repay your loans. So Jonah, tell me, if all of this stuff that we're saying is true, why do people still think that you're just paying to borrow your own money?
It's easy. It's because nobody taught them how money really works. And honestly, most of the loudest voices on this topic have never actually used a properly designed policy. They just get to reap the benefits of bad-mouthing this 200-plus-year-old product without having to address any of the facts. And then they happily rake in all the business from the people that are scared away from actually wanting to educate themselves as they convince them to buy term. It's less expensive. Invest the difference. Put your money where it can be at risk. That's the best way to go. Don't forget, Sean, with that route, they are guaranteed 12% because the market never fails. Remember, we saw that in the video.
I see what you did there, Jonah. But honestly, they think whole life equals low returns, low flexibility, no access, and that might be true if you're buying one of those tiny $25 a month off-the-shelf policies for your newborn.
But that's not what we're talking about here. We're talking about a properly structured policy with a small group of the best mutual companies that allow them to build maximum cash value, allow you immediate access and real leverage. Then, once you have that, we start banking.
So let's recap, Jonah. You're actually not borrowing your own money. What you're doing is you're leveraging an asset to access capital while your money keeps working for you, right?
Exactly. And you know what? I was just thinking, you want to know what doesn't make sense to me? Letting your dollars sit in the bank earning 0.1% interest when they could be working double time.
Agreed. Except double time of a penny is 2 pennies. So let's maybe look at moving your money into a more efficient place so you can start having it really work for you. With that being said, if you've been on the fence about infinite banking, now's the time to take a deeper look. Check out our full infinite banking overview in the description below and book a call with us. Get on our calendars and let's discuss exactly how this would work for you in your life. Whether you're looking to pay off high interest debt, like a lot of people start with, or save for a vacation, maybe build some passive income, it's called infinite banking for a reason. The possibilities are endless, you guys.
And hey, if you like this myth-busting breakdown, you've got to hit the like button, subscribe, drop a comment on what myth we should bust next. We'll catch you in the next video. Peace.